Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm a managing principal and portfolio manager at T2 Asset Management. Before we get started, this video is for educational purposes only. Opinions expressed in this video are mine, don't reflect the opinions of other managers. You should always consult your financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, it seems like everybody today just wants to know what's going on with this market. It seems to me that many investors have very short memories or just don't really remember many of the previous market cycles that we've experienced. As Mark Twain once famously said, history doesn't repeat itself, but it often rhymes. Today's market is very similar to past cycles. What's happening today is very similar, as a matter of fact, to what happened in the 60s as well as what happened in the late 90s during the tech bubble. The two periods had very important factors in common. Both of those periods in the 60s and 90s were both driven by a very accommodating Federal Reserve. In the 1960s, heavy government spending on the Vietnam War and President Johnson's Great Society programs were met with low interest rates as money supply exploded. And in the 90s, the Federal Reserve pumped the system again in preparation for Armageddon of Y2K. Both of these periods experienced strong market performance as easy money allowed equity risk premium to drop significantly. Here we have a chart of the S&P 500 index during the 1990s. As I mentioned, stock performance was very strong. It rose about 350% from 91 through 99 until the Fed was forced to take away some of the accommodation, and inevitably equity risk premium shot up, and the result was that markets fell hard. By the way, equity risk premium, it's a measure, it measures the extra returns that stock investors demand over government bonds for the risk of losing their money. In essence, when risk premium goes from high to low, you do well. And when risk premium goes from low to high, you don't do very well. So let's take a look at the 1960s. Similar story. The market ran up about 70% from 1960 through 69. When it was clear that inflation was picking up, equity risk premium shot higher and markets fell. However, this period, unlike the 90s, took nearly 20 years for the market to recover. The point I'm trying to make here is that risk matters. Yes, the Fed can manipulate interest rates, it can print money, it can do a lot of things in the short term and continue to artificially inflate financial assets, really until it can no longer do so. And what's going to cause that to happen today? I think inflation. There are far too many similarities between the 60s and today, whether it's government spending, low interest rates, money supply, supply and demand imbalances. These two periods are eerily similar. So let's take a look at what happened in the 60s. Here we're going to run through a little flow chart, so try to pay attention to each of these points. Heavy government spending on the Vietnam War and President Johnson's Great Society programs were met with low interest rates. Money supply grew strongly. The economy overheated because of the excess money supply. The economy's output gap went negative as demand outstripped supply. The excess demand turned into a long-term trend of increasing supply, which allowed the labor force to grow and people demanded higher wages. The more volatile dollar fed into higher prices, which made inflation even more volatile. And as this uncertainty took hold, investors became more and more concerned, and equity risk premium rose again. And finally, the stock market returns suffered significantly. Now, if you're following this flow chart, do you see any similarities to what's happening today? It's kind of eerie, isn't it? Now, let's take a look at a few things. First, the Fed's balance sheet has ballooned to over $8 trillion. Interest rates are being manipulated by central banks around the globe, forcing people into riskier assets, thereby driving equity risk premium to very low levels. Leaving stocks really exposed and without much cushion against any uncertainty that may be ahead of us. Recent inflation numbers are hitting some of the highest levels we've seen since the 80s, and the Fed is enabling huge government spending. We have the federal government spending trillions upon trillions of dollars as if it were nothing. Without the Fed manipulating interest rates, there is no way the government can embark on their $10 or $20 trillion spending programs like we've seen over the last year and some of the programs we're still about to see. Just imagine for a second what the cost of all these spending programs would be if interest rates were at 5% as opposed to 1.25%, 1.5%. Now, let's take a look at a few things that are being ignored by many in the media and quite frankly, a lot of people, market participants. I'm going to try to run through these things, these charts pretty quickly, so bear with me if it goes a little bit fast. But here we have the Fed's balance sheet. As you can see, the balance sheet is now over $8 trillion. And by the way, this next chart here, the total U.S. debt is now over $28 trillion. Next, we need to take a look at the 10-year Treasury yield. As this chart here shows, the 10-year is now at 135. With inflation running as high as it's been, how is this even possible? If the economy really is running as hot as the numbers are showing and inflation numbers are at levels not seen in decades, how can the 10-year be this low? Well, the banks aren't lending. They're simply holding deposits at the Federal Reserve and buying treasuries and agency debt in order to capture net interest margin without any credit risk. And here you can see on the chart shows that banks own nearly $4 trillion in treasury and agency securities, with only about $2.5 trillion in outstanding commercial and industrial loans. Just think about that for a quick second. Banks are paying you, the depositors, nothing on your checking or your savings accounts right now. Then they take your money and they buy treasuries and agency securities that may pay them 1%, 2%, 3%, depending on the maturities. The difference that they're making between what they're paying you and what they're keeping is considered net interest margin, and they're able to capture that profit without any credit risk whatsoever. And that leads me to the final chart here, the money supply. Almost every so-called expert on TV seems to repeat the talking points from the Fed that inflation is transitory. Okay, it was transitory in the 70s as well. The problem with the word transitory is that you need to put a timeline on it. The reason I think inflation will be a bigger problem and a longer lasting problem is this chart right here. This chart shows the velocity of money. In essence, it shows how fast money circulates through the economy. As of now, money has been sitting still for many reasons. Some of them I already mentioned. However, I expect velocity to pick up soon, and that's going to ignite even higher inflation. Remember the flow chart we just talked about earlier about the 60s? We're currently in a supply-demand imbalance. Soon, the additional unemployment benefits will expire. Companies are going to need to hire more and more people in order to meet the demand. Wages are going to increase. Money will once again circulate through the economy. Inflation will rise, and the Fed will be forced to raise interest rates. This is just basic economics, people. So what does all this mean for stocks? Well, here we have the PE ratio for the S&P 500. And as you can see, the market's PE ratio is over 46. Just a year and a half ago, it was only 24. Remember earlier when I talked about the equity risk premium back in the late 60s? Today, there's virtually no equity risk premium. Investors aren't demanding any premium to invest in stocks. As a matter of fact, they don't even care. Just look at what the Robinhood traders are doing. The other day, I saw two bartenders at our local restaurant trading stocks on their phone while making drinks. The problem is that when the Fed is finally forced to raise rates, or when the market starts to think the Fed will need to raise rates, there's no cushion to protect stock investors. If you go back to almost any period in history when equity risk premium was this low, the following few years are awfully tough for investors. The $1 million question, or I guess in today's world, the $1 trillion question, is when. And that's impossible to know. None of us have a crystal ball, but my job is to manage risk so that you don't get blindsided. When risk is high, as it is today, I will reduce exposure to stocks. This means that we won't get all of the upside of the market if it keeps grinding higher, but that's okay. It's better to leave a few percentage points on the table in order to preserve all of the gains that we've made over the years and not end up watching our portfolio drop by 30, 40, 50%. Many investors still believe that fundamentals don't matter and markets will always go up. I guess, there's nothing to really be learned from the 60s, the 70s, the 80s, the 90s, the financial crisis of 2008, or even the spring of last year when the pandemic started. So now what? Well, in my core equity portfolio, I've reduced my exposure to stocks by about 40%. The exposure I do hold is tilted to consumer staples, a defensive sector, and materials, which is an inflationary play. I also have some exposure to broad commodities as I expect supply to continue to increase to meet demand and drive commodity prices even higher. As a cushion, I'm holding about 30% in cash right now. So to summarize, prepare yourself for more inflation, prepare yourself for higher interest rates, prepare yourself for higher taxes, and don't go picking up pennies in front of a bulldozer. Look, the Fed will be forced to take away at least some of its accommodations soon, and when it does, equity risk premium will go up, causing pain for stock investors. I don't know if it'll be next week, next month, or next year, but the market will sniff it out, and if you're not paying attention, it will be yet another lesson in market analysis and history. So, as always, thank you for watching, and if you have any questions or comments, please give me a call or send me an email. I hope to see you again next month.